Most people work their entire lives saving money, only to retire with barely enough to survive. That's not a savings problem. That's a strategy problem. And today, I'm going to give you the exact step-by-step roadmap to turn what you're already saving into actual, lasting wealth. Let's start with the harsh truth nobody tells you. Saving money alone will never make you wealthy. If your money is sitting in a regular bank account right now, inflation is quietly eating it alive. Every single year, the purchasing power of that money shrinks. You're not standing still. You're slowly moving backward. That realization should make you uncomfortable enough to take action, because what comes next is going to change how you think about your finances forever. Step 1 is building your financial foundation. Before you invest a single dollar, you need a safety net. This is your emergency fund, and it should cover 3 to 6 months of your living expenses. Not investing money. Not opportunity money. Pure, liquid, accessible cash sitting somewhere safe like a high-yield savings account. This is non-negotiable. Without this cushion, one unexpected crisis forces you to pull money out of investments at the worst possible time, destroying years of progress in a single moment. Step 2 is eliminating high-interest debt. Credit card debt carrying 15, 20, even 25% interest rates is the enemy of wealth building. No investment consistently beats those returns. Paying off that debt gives you a guaranteed return equal to whatever interest rate you're eliminating. Attack it aggressively using either the avalanche method, targeting the highest interest rate first, or the snowball method, knocking out smaller balances to build momentum. Both work. Pick the one you'll actually stick with. Step 3 is where your savings start working for you. Once your foundation is solid and toxic debt is gone, it's time to invest. Start with tax-advantaged accounts. If your employer offers a retirement plan with a matching contribution, contribute at least enough to capture that full match. This is free money, and walking away from it is one of the most expensive mistakes beginners make. After that, consider maxing out individual retirement accounts depending on your situation and income level. Step 4 is understanding the power of index funds. You don't need to pick individual stocks. You don't need a financial advisor charging you fees to beat the market, because most professionals don't consistently beat the market anyway. Low-cost index funds that track broad market indices give you instant diversification across hundreds or thousands of companies. Historically, the stock market has delivered significant long-term returns despite short-term volatility. Time in the market consistently beats timing the market. The earlier you start, the more powerful compound growth becomes. Now here's where the emotional side of investing gets critical. Markets will drop. Sometimes dramatically. You will feel the urge to sell everything and protect what you have. That instinct is natural but almost always wrong. The investors who build serious wealth are the ones who stay calm during downturns, continue investing consistently, and trust the long-term process. Reacting emotionally to short-term market swings is how ordinary savers stay ordinary savers. Step 5 is increasing your income streams. Savings and investing are powerful, but there's a ceiling to how much you can save if your income never grows. Look for opportunities to develop skills that command higher pay, start a side income, or build assets that generate passive income over time. Every additional dollar of income that you redirect into investments compounds your wealth-building momentum dramatically. Step 6 is regularly reviewing and rebalancing your strategy. Wealth building isn't a set-it-and-forget-it process. At least once or twice a year, review your portfolio. Make sure your asset allocation still matches your age, risk tolerance, and financial goals. As you get closer to needing your money, gradually shifting toward more conservative investments protects what you've built. The most important psychological shift you need to make is this. Stop thinking of investing as something rich people do. Investing is how people become financially free. The gap between where you are and where you want to be is simply a gap in consistent action over time. Small amounts invested consistently across decades create outcomes that feel almost impossible when you're starting out. Here's your action plan right now. Calculate your monthly expenses and determine your emergency fund target. List every debt you have with its interest rate. Open a tax-advantaged investment account if you don't already have one. Set up an automatic monthly contribution so you invest before you have the chance to spend it. Then commit to not touching it. Wealth doesn't come from a single massive decision. It comes from a series of small, smart decisions made consistently over time. Your savings are already the starting point. The question is whether you give them the strategy they deserve. Start today, stay consistent, and let time do the rest.